Good morning. David Schill, Catapult Wealth Partners, with the market update for the week of August 29th. Well, last week, the equity market sold off rather heavily, with all of the major indices being down approximately 4%. That ranged from 4.04 in the S&P 500 to the technology-laden NASDAQ, which was down 4.44%. The international markets were actually down somewhat less. The EFA index was down 2.93%. And the small cap index also performed a little bit better than the large cap index. Stocks responded to the comments made by Jerome Powell at the Federal Reserve Bank's meeting that was held in Jackson Hole, Wyoming, where he didn't really say anything remarkably new, except for the fact that he said that we will keep at raising rates until we're confident that the job is done, and that households should prepare themselves for at least a little bit of pain ahead from these rising interest rates. So pretty tough talk from Fed Chairman Powell. Again, nothing really very different from what we've heard before. Somewhat surprising that his meeting his address only lasted all of 10 minutes. There'd been a lot of speculation built up over the course of the last couple of weeks. But the Fed is firmly on the path to continuing to raise interest rates until they get this inflation bogey under control. And the reason that the market sold off heavily, particularly on Friday with the Dow down over 1,000 points, was really this ongoing tussle again, as I spoke about last week, of what the markets expect. And the markets clearly expected that the Federal Reserve might have been a little bit more dovish, that they're seeing better inflation numbers and probably seeing at least some light at the end of the tunnel where they can slow down the pace of rate increases, both in magnitude and frequency, and that certainly did not occur on Friday. We also saw during the week that several retailers reported earnings that were a lot weaker than expected. Nordstrom and Macy's reduced their forecasts for the remainder of the year, as did Zoom Video. They lowered expectations, now only see growth rates in the single-digit range. Bed Bath & Beyond, a staple of the retail scene in this country for several decades, required additional financing to shore up liquidity. And the dollar stores had mixed results. Dollar General beating expectations, Dollar Tree missing expectations. So it definitely seems as if the higher interest rates are starting to slow the consumer down, even though inflation numbers have moderated somewhat. And the Fed seems, committed to the path of raising interest rates. During the coming week, the Bureau of Labor Statistics, probably the most important number that comes out, will be the jobs report for the month of August. And we're certainly expecting an additional increase in the number of jobs created, somewhere in the 250,000 job range, with the unemployment rate remaining at about 3.5%. Again, expect heightened volatility during the week. Still some hangover from the Fed chief's comments on Friday. Markets look set to open a little weaker on Monday this morning. And happy investing for the week ahead, and have a great Labor Day. We'll see you again next week on Tuesday, as we will be off for Labor Day. Thank you, and have a great week.